The next presenters for today are Parker Lymenstull, Nolan Christian, and Marcel Kaspar. They will share research on analysis of the impact of COVID pandemic on the financial ratios of companies in specific industries. Their mentor is Dr. Vicki Edson. I'll turn it over to you.
Thank you so much, Kristen, for introducing us. So, hello, my name is Nolan.
My name is Parker.
And my name is Marcel.
And today we're going to be talking about the different industries that have been impacted through COVID through financial analysis, which is basically just looking at different financial information to see how exactly each of the industries have been impacted due to COVID. Okay, so back in 2021, we were interested, since the COVID pandemic just ended, we were pretty interested to see how all the different industries had been impacted, just to take a look to see if some had been positively impacted or negatively impacted. So basically, the way that we had figured out how to study with those, we're looking at what are known as financial statement ratios. So basically, that's just looking at different information such as the income statement and the balance sheet and analyzing all that different information to see how exactly each of the industries had been impacted. So before we get started with this presentation today, I wanted to give a few thank yous to, we had many different people. Unfortunately, a lot of them could not make it today because they had actually graduated last year. So I want to give a thank you to Sarah, Sydney, Rodney, and Rodney and Nathan. And also there were a few other people today that aren't presenting, but we want to give them a thank you who also analyzed a few of the ratios for us to give us the graphs that we're going to be showing, Shannon and Cassidy. And then, of course, us three who also worked on the ratios. So I'm going to go ahead pass it off to Parker, who's going to talk about more of the methodology and how exactly we analyze the different ratios.
Thank you so much, Nolan. So as Nolan had mentioned, this is a project that's been in development for almost a year and a half now. At the first IMA Club meeting in August of 2021, all the students in the club got together and discussed what they wanted to research, and they settled upon studying what industries were affected by COVID-19. We had to identify what industries we wanted to use, and we did this by determining what the North American Industry Classification System's code number for these industries were. And once we determined that, we went and looked up different companies that we thought were in this industry. We had to collect it all by hand, so this was not a short process, I will say that right now. And we wanted to choose larger firms we were familiar with so we could understand and have a common knowledge about what and how these were affected. And we had to confirm that they were under that NAICS code number just so we could have accurate information for that. We then went to our financial textbook, The Essentials of Corporate Finance, to determine the ratios. We determined them by the standard ratio categories. We had 5 categories we eventually settled upon. And we had to determine when we were going to say COVID was impacted. So since we were focusing mainly on the American economy, we chose March of 2020. That way, because remember, if you all remember that President Trump announced COVID was coming to America at that time. So we decided that any financial statements that had their year ends after March of 2020 would be classified as post-COVID, and for that cancellation, because it was 2 years afterwards, we had 2 years of pre-COVID as well. We then went to their financial statements and it computated the ratios, and we ended up creating graphs for those 4 years that we did computations for in order to see what the difference between pre and post-COVID years were. We visually examined those graphs, and then we made sure that the graphs that were similar in their ratios, so let's use, for example, we used fixed assets and asset turnover, were very similar, so we decided to merge them on into that because they had very similar results. And then we all had to average the pre and post-COVID computations so we could compare them to each other in an apples-to-apples comparison. And next up, we had to determine our hypothesis, and for our hypothesis, I will hand you over to Marcel.
So like Parker said, the next step was to define a hypothesis. We had a null hypothesis and an alternative hypothesis. The null hypothesis basically said that there's no difference between the means for the financial statement ratios for pre compared to post-COVID, and then we set up an alternative hypothesis for our research, which basically said that there is a difference between the financial ratios on pre to post-COVID. Next, we went up and computed paired t-tests on each of the remaining ratios in the study, where we compared the means of all the companies and noted like significances between pre and post-COVID. Similar paired t-tests were ran then on each industry, on each ratio, and we noted kind of a difficulty on relying on this test, since some of the sample sizes were really, really small for some industries. And lastly, the results were examined like in a tool-tail test, since the results could either be an increase or a decrease. Next up is some general information about the paired t-test. It is used to test whether the mean difference between pairs of measurement is 0 or not. The test subject must be the same ones in the before and after group, and the test subjects must also be independent. And lastly, the measured differences are normally distributed, which was also kind of difficult because of our small sample size. Some of the results were questionable. Next up is Parker, who tells you a little bit more on how to read the results on the paired t-test on Excel.
Once again, thank you so much, Marcel. So as you can see on the board, this is an example of our paired t-tests. So we had to choose enough information to tell you in this presentation. So in order to do that, we had to choose what results were significant and which ones were not significant. So on the board with airlines and crude oil example, we end up using what we call the p-value or the p-two-tail value. And we had to determine whether or not, what percentage of confidence we were confident in presenting with results. So if the p-value was less than 0.05, which is almost like a less confidence level, so a doubt level, if it had less than a 0.05% doubt level, we decided that it was significant. As you can see with the airlines, it was 0.001, so a 0.1% doubt, which means that had a very high confidence level, so we determined that that data was significant. While with crude oil, it had a 0.20, meaning that was a 20% doubt, which means we determined that was not significant information. For this research, we did 7 different industries. We did the airline industry, hotel, meat packing, retail grocery stores, crude oil, restaurants, and motor vehicles. We used a lot of big name companies for each industry. So for airlines, we used things like United and Delta Airlines. For crude oil, Chevron and ExxonMobil corporations. For motor vehicles, we use popular companies like Ford and Tesla. I'm sure we all are familiar about those, especially as of late. Retail grocery stores, Walmart and Kroger Company. And then popular hotel brands like the Hilton and Hyatt hotels, restaurants like McDonald's and Chipotle and Yum Brands, which is essentially Pizza Hut and Taco Bell, and then meat packing companies like Tyson Foods. Here are some of the ratios that we did do. We did 5 categories, as I mentioned earlier. We did 2 debt leverage ratios, we did 4 profitability ratios, and we did 5 activity ratios. We did 1 liquidity ratio, and we did 3 different price ratios. And now, to talk about these ratios further in depth, I'm going to hand you over to Marcel to talk about our debt ratios.
So first up is the debt to asset, which indicates how much debt per dollar there is for each asset. The overall results, we took all 32 companies, and the results overall were not significant. However, we had 2 significant industries, which was airlines and hotels. Next up is debt to equity, which indicates how much debt there is per dollar of equity. The results, again, overall were not significant, and for this we had also no significant industries. So next up, I have 2 graphs which show airline and hotels for debt to asset. On the left, you can see airline, where you can see the pre-COVID mean increased about 14% compared to the post-COVID mean to up to 82%. And for hotels, a similar graph can be seen that the pre-COVID mean increased to post-COVID year, which makes sense since these 2 industries were mainly affected by lockdowns. Next up is the profitability ratios, where we had gross profit margin, which indicates the amount of revenue that is left after the cost of goods sold is covered. The overall results were not significant. However, we had again two significant industries, which were crude oil and retail grocery stores. Next up, we have return on asset. It indicates how much how profitable the company is related to their assets. The overall results were significant here, and the significant industries were airlines and restaurants. So again, two graphs. On the left, you can see crude oil. On the right, you can see grocery stores. However, it is notable that for both, the gross profit margin increased pre-COVID to post-COVID. For the return on asset, it can be seen that for airline and restaurants, again, the return on asset decreased from pre-COVID and post-COVID, which mainly negative affects the companies. For airline, we have the pre-COVID mean declining from 6% to -3%, and then we have for restaurants the pre-COVID mean of 17% declining to 11%. The other two profitability ratios we had left was return on equity. It indicates how well the company is converting its equity financing into profits. The overall results were not significant, and we also had no significant industries. And lastly, we had after-tax profit margin, which indicates the percentage of sales that is retained as net income. The results here were significant, however, we had no significant industries. To talk more about the activity ratios, Parker is going to talk more about that.
Once again, thank you so much, Marcel. So the first activity ratio that we decided to focus on was inventory turnover, which was indicating how well a company was using its inventory to help generate revenue. We did find the overall results for all 32 companies to be significant, and more specifically with industries, we focused on airlines. And the other ratio was net working capital, which was determining how a company used its available capital in order to generate revenue. We found out that the overall results were not significant, and there were no significant industries within that results. Now, as you can see on this graph here with inventory turnover with airlines, in 2018, 2019, it's very steady. It's on a little of a decline for some companies, but nothing real too significant until you get to 2020 when it takes a huge downturn. And I'm sure we all remember during COVID time where we went on lockdown, and that's a huge part for airlines, because airlines weren't able to use their inventory because so many people weren't buying flight tickets as much as they were. So airlines could not use their inventory as effective as they were pre-COVID in order to make revenue. The next ratio was asset turnover, very similar to inventory turnover, as a company is using their assets to generate their revenue. We found that the overall results were not significant. However, there were 4 industries that were significant, with airlines, hotels, restaurant, and retail grocery stores. And the other ratio was average collection period, which is how long it takes a company to collect its accounts receivable and turn them into cash. We found that the overall results for all industries were significant, but the industry we wanted to focus on was airlines. Pictured here is the asset turnover for airlines and hotels. As Marcel had said earlier, hotels and airlines were heavily affected because, like we said, we were all in lockdown, so people weren't traveling all over the place to go to airlines, and that also hurts the hotel industry because the hotel industry wasn't able to rent out rooms to anyone, so they were not able to use their assets to their fullest advantage in order to generate revenue, and that's why they take a huge dip in 2020. The same goes for restaurant, grocery stores. Restaurant, we all weren't going out to eat necessarily, so we weren't spending money at the restaurants, so they couldn't use their assets to their fullest extent. Grocery stores, while a lot smaller, did have a little of a decrease going into it because obviously we weren't wanting to travel to go to the grocery stores, especially during March of 2020. Then for average collection period, we want to focus on airlines here because as you can see, 2018, 2019, once again, very steady. But in 2020, it takes a huge jump in how long it takes these companies to collect on their accounts receivable. And the reason for that is because a lot more people were very frugal with their money when it came to COVID. So they weren't able to pay off their debts as fast. And we all know how airline tickets can be. They can be kind of expensive here and there. So it was a lot harder for airlines to recoup those accounts receivable and turn them into cash. The last activity ratio we focused on was days of cash, which is how many days The company had cash on hand. We found that all overall results were significant and that there were 3 significant industries of airlines, hotels, and retail grocery stores. For airlines, once again, another huge jump going into 2020. As Nolan had mentioned earlier, with the debt, Marcel mentioned earlier, my apologies, that the debt was going up for every single company. So it makes sense that they're taking out more loans, meaning that they're going to have more cash on hand. The same goes for hotel because their debt ratio was going up. They ended up having more cash on hand because they need to pay off their operating expenses in the short term. So they had a lot more long-term liabilities. Grocery stores are very similar, but not as long with cash on hand because we were still ordering groceries online. And now to tell to you about liquidity ratios, I'll hand you off to Nolan.
Thank you, Parker, for handing me off. So basically now we're going to go into the liquidity ratios, and this basically just is going to talk about how easily a company is able to pay off its current, with its current assets to pay off current liabilities, just how easily they can. So when performing the T-statistic test on it, we could see that there was actually significance, and to pre-COVID to post-COVID, there was actually an increase when compared to that, meaning that more companies were able to pay off more current assets or have more of the ability to when compared to the previous years, because as Parker was mentioning, a lot of companies were taking on more debts when compared to just to make sure to increase their buffer just in case during the COVID. And so for the significant industries though, but specifically there were airlines and crude oils that showed a significance with that. So as you can see with airlines and crude oil, both overall just showed an increase with their current assets. They wanted to be able to make sure that they could pay off their things because COVID was hitting and they were worried they wouldn't be able to pay off any debts, which could cause many different issues related to it. So now I'm going to go into the price ratios. So that's basically just looking at a company's stock when compared with income, and then also to see if they were the companies that were paying off dividends, to see how they were, to see how it compared to each of the industries. So when doing a test with that, we did price to earnings first, which is comparing its market price per share to the earnings per share, which is basically just the income to the number of shares that each of the companies issued. And performing the results on that showed there was no significance, and there was also no significant industries. The next ratio that we looked at was dividend payout, which is basically for the companies that were paying out dividends divided by the earnings per share again. So basically the amount of income per the amount of shares that they issued. So when looking at that ratio, we saw that there was overall not a significance. However, we did have a significant industry, and hotels did show a significance with this ratio. So when looking at hotels, you could see that there was a pretty big dip, and it actually went negative. That just basically means that they had negative net income, which is why it dipped down negative, and why they had negative net share. So it was higher at least before COVID, and then after COVID, while it rebounded in 2021, it definitely went down when compared to all the other companies. So the last ratio that we looked at was dividend yield, which is basically looking at the dividends that each company paid out related to its common stock price, the price that it's issuing. And we had, after doing the significance performance, it showed that there was no significance with any overall, and there were also no significant industries. So our overall results, I would say that there are definitely 4 industries that have been mainly impacted when looking at each one of them. Those were airlines, restaurants, grocery stores, and crude oil. So airlines definitely, as you could see, they hit almost every single ratio of being negatively impacted, mainly just because not a lot of people wanted to fly out. They wanted to stay home, and I mean, most places were closed anyway, so even if they wanted to fly out, they really couldn't do anything, so it was a whole lockdown order. So they had big losses to net income, and then they were issuing a ton of debt, so to back that up, because they knew that they were going to lose a lot of income because of all the shutdowns. So that's why a lot of those ratios there, you could see the impacts with those. Restaurants had also mainly been negatively impacted. Once again, people wanted to risk not being able to go out as much, so they just wanted to stay stay home as much as possible, so they didn't want to go out, so they just stayed. And then we also had grocery stores who had actually been positively impacted, mostly because most companies wanted to, most people wanted to stay home, but they still had to order some groceries of some kinds just so they can actually eat. So that's why it had, however, it did have a decrease in the asset turnover, which mainly just has to do with that while they were making good profits, they still weren't utilizing their assets as much as they could have. And then finally, we have crude oils. Now, a lot of people might think that crude oils is tied in with gas. However, there are many different things related to crude oils, such as like boats that need it and such. So that's why they had actually been positively impacted when compared with all the other ones, is that things still needed to ship. There's way more with crude oils related to that, which causes a positive impact. So the overall, just with all the industries we've compared, we just saw that a lot of companies were losing income and many were issuing many different kinds of debt, basically. So I do want to point out there were a few different limitations to the study that we had. So as we talked about a little bit, normally with the statistic test, we do what's called a normal distribution, which is looking at the mean. And basically, we had a small sample size, which kind of limited the ability to be able to do that test. We also had a limitation with the number of industries. So car companies only had 3 of them, while meatpacking only had 4 industries. So that limited the amount of data related to testing the significance of them. We also had only in the year 2020 had 9 months of COVID. So basically, when looking at COVID years, 3 months of it we did have 3 months of non-COVID, so it would have been normal operations, which could have skewed the data a little bit when compared if COVID happened throughout the entire year to see how it would have negatively impacted. We also had some companies have different year ends, so basically because of that, some of them might have been impacted because they had a certain cutoff date when comparing with their financial statement information. So that could have caused, and then we also had some ratios just could not be computed, unfortunately, mainly because there was some financial information missing, mainly just some inventory accounts, and then cost of goods sold sometimes wasn't included within the ratios. And then, of course, we also had, as you saw before, we had different researchers that helped us out for this project graduate, so some information could not have been gathered, or at least we couldn't have checked with them to make sure all the information was correct. It would have had to all happen back in 2022. So some recommendations for future study, I would definitely say getting bigger sample sizes of companies, just being able to gather more companies per the industry, such as like car companies, to see if it had more of a significance, if we had gathered more of the sample size. We'd also probably research more industries, such as maybe even like companies like DoorDash and like food delivery, to see how exactly they might have been impacted through COVID. And then also, of course, expanding COVID since 2022 just happened, just to see how exactly the industries were impacted, to see if it's gone back up, if it's going down when compared to the COVID years. And then we probably also want to run similar studies that we have more financial information on, because even though it's been 2 years, it could even impact us even for the farther future when compared now. So looking at different impacts, similar impacts, such as like a stock crash or the housing crash, to see how exactly those compared with how the COVID impact happens. And that's all I have for you guys.
Do we have any questions?
So I realized you picked specific industries, and you did a reasonably good job with that because they appeared to be troubled industry. Did you consider looking at the entire market just to see if it went up or down between the first group versus the second group, meaning use something like the stock prices for the complete market? Did you consider that?
So just like the general market rather than, specific
Was this a
industries?
systematic occurrence that impacted everybody? So was the market up or down from the first group to the second group? The overall systematic, the entire economy basically is what I'm saying.
You guys want to take it? Okay.
We did not consider it at the time, but we would recommend for future presentations that if they were to do this again, to recommend to look into that.
Okay. Thank you.
A fair amount of your analysis looked at debt that these organizations took on. Did you, when considering debt, look at, or would you consider looking at, if you were to do it again, the way that that debt interfaces with the availability of federal subsidization, that many of these debts were interest-free offerings from federal programs that ultimately are written off on the organization's books?
Yeah, I definitely probably take a look exactly, of course, like the interest rate related to each of the debts and to see if there were any like write-offs. And I do know like the government did provide like employees. I don't know about specifically business-wise, but there were definitely a lot of government funding related to help make sure that each of the companies, were in running functioning conditions so that once we get post-COVID, they could be able to function as normal operations because they definitely did have a lot of operating losses.
Any other questions? Thank you, Parker, Nolan, and Marcel.